Target was once one of Wall Street's favorite retailers. During the pandemic, everything seemed to work. Stores were busy. Digital sales exploded, profits jumped, and investors believed Target had entered a completely new level of growth. Target shares climbed to an all-time closing high of roughly $230 in November 2021, with the intraday price going even higher. Then the story completely reversed. The stock eventually fell to a recent 52-week low of just $83.44. That means roughly two-thirds of the company's peak stock market value disappeared. But here's the strange part. Target did not go bankrupt. It still generates more than $100 billion in annual sales. So why did Wall Street punish the stock so badly? To understand the crash, we first have to understand how good 2021 was. Target generated about $104.6 billion in sales that year. Comparable sales jumped 12.7%. Operating income reached almost $9 billion. Operating margin hit 8.4%, and earnings per share reached $14.10. Those were extraordinary numbers for a traditional retailer. Investors started believing that pandemic-era profitability might be sustainable. That assumption became extremely expensive when reality returned. And that brings us to reason number 1. Growth stalled. Look at the same-store sales trend. Target posted 12.7% comparable sales growth in 2021, then just 2.2% in 2022. Then negative 3.7% in 2023, almost zero growth in 2024, and another 2.6% decline in 2025. That is not 1 week quarter. That is a multi-year slowdown. Meanwhile, investors could look across the retail industry and see Walmart, Costco, and Amazon competing aggressively for the same consumer wallet. Wall Street began asking a dangerous question. Was Target experiencing a temporary slowdown, or had the company actually lost momentum? Reason number 2 was the inventory disaster. This was one of the biggest turning points. Target bought merchandise based on what customers had been buying during the pandemic. Furniture, electronics, home products, clothing. Then consumers suddenly changed behavior. They started spending more on travel, restaurants, and experiences. Target was left holding too much inventory. So what did management do? They marked it down. Aggressively. The result was brutal. In the second quarter of 2022, Target's operating margin collapsed from 9.8% to only 1.2%. Operating income fell about 87%, from roughly $2.5 billion to just $321 million. Think about that. The stores were still open. Customers were still shopping. But profitability almost disappeared. That moment told Wall Street something important. Target's earnings were much more fragile than investors had assumed. Then comes reason number 3. Target sells a lot of things consumers can postpone buying. Yes, Target sells groceries and household essentials. But a huge part of the Target experience is discretionary. Apparel, home decor, electronics, toys, furniture, beauty. And when inflation hits, consumers make choices. Rent comes first. Groceries come first. Electricity comes first. Credit card payments come first. That new throw pillow? Maybe next month. This became especially painful because Target had benefited enormously when consumers were stuck at home buying those exact categories. Once household budgets tightened, discretionary spending weakened. Target itself repeatedly reported weakness in discretionary merchandise, even while categories like beauty and essentials performed better. Now, we get to reason number 4. Target's brand and customer traffic became less dependable. Target's advantage was never just price. Walmart can compete on price. Amazon can compete on convenience. Target's magic was different. People went into Target for toothpaste, and somehow walked out with candles, clothes, snacks, and a new lamp. That impulse shopping experience is incredibly valuable. But Target went through years of controversy, changing consumer sentiment and inconsistent traffic. Regardless of anyone's political opinion, investors care about one thing. Does controversy reduce store visits or sales? At the same time, shoppers became more price sensitive. The customer who once casually added 3 discretionary products to the basket started thinking twice. And when fewer customers visit, or each customer buys less, the economics of a giant store network become much harder. Reason number 5 is execution and competition. Target wasn't standing still, but neither was anyone else. Walmart became better at e-commerce and delivery. Costco kept winning with value and loyalty. Amazon kept raising the standard for convenience. Meanwhile, Target had to deal with issues such as inventory availability, checkout experience, store staffing, promotions, and merchandise freshness. And management's current strategy tells us how serious the problem became. Under CEO Michael Fidelka, Target plans more than $2 billion of incremental investment in 2026, including about $1 billion in additional operating investment and more than $1 billion of additional capital spending. The goal is better stores, better staffing, better merchandising, better technology, and a more consistent customer experience. Companies don't make investments that large unless management believes meaningful repair work is necessary. So after all of that, why are investors suddenly paying attention again? Because the numbers finally started improving. Target's first quarter of 2026 was much stronger. Net sales increased 6.7%. Comparable sales increased 5.6%. Customer traffic increased 4.4%. Digital comparable sales increased 8.9%. Same-day delivery grew more than 27%. And sales increased across all 6 of Target's core merchandise categories. Management responded by raising its full-year sales outlook to growth around 4%. That matters because Wall Street doesn't need Target to become a high-growth technology company. It needs proof that the decline has stopped, and the stock has already reacted. From the $83.4 $4.52-week low, Target shares have staged a dramatic recovery, closing around $155.51 on August 13, 2026. So investors are already beginning to price in a turnaround. That also means the next stage becomes harder. One strong quarter can create optimism. Several strong quarters are needed to create confidence. So, what would make Wall Street truly bullish? First, positive comparable sales, not for one quarter, consistently. Second, traffic growth. I want more customers shopping at Target, not sales growth created only by higher prices. Third, watch apparel, home, and other discretionary categories. If those categories recover, it tells us the Target customer is spending beyond necessities again. Fourth, watch operating margins. Q1 2026 adjusted operating margin was about 4.5%. That is improving from some recent weak periods, but it is still nowhere close to the extraordinary 8.4% margin target produced in 2021. If Target can grow sales while steadily rebuilding margins, earnings could improve very quickly. And fifth, watch whether management's huge investment actually improves the customer experience. Are stores cleaner? Are shelves stocked? Are checkout lines shorter? Are new products creating excitement? Is same-day delivery growing? Are customers returning more often? Those simple questions eventually show up in the financial statements, and that is the real Target investment story today. The bear case says Target permanently lost some of the brand power and consumer loyalty that once justified a premium valuation. The bull case says this was an execution problem, not a broken business. Fix the stores, fix the merchandise, bring traffic back, protect margins, and a company doing more than $100 billion in annual sales suddenly becomes very interesting again. As a retail investor, Don't try to predict Target's future from the stock price alone. Watch comparable sales, watch traffic, watch discretionary spending, watch margins, and watch execution. Because if all five start improving together for several quarters, management won't have to tell Wall Street that Target is back. The numbers will tell the story. And if you enjoy breakdowns like this, where we go beyond the stock chart and uncover what is actually happening inside the business, subscribe to the channel and turn on notifications. Because the biggest opportunities often appear when Wall Street has already given up on a company. But the trick is knowing the difference between a stock that is simply cheap and a business that is actually turning around. Subscribe, and let's find that difference together.